Let's go ahead and get started here. So if you guys don't know Amanda and Matt already, they're probably the most well-renowned CPAs in the bigger pockets community. At least that's how I found you guys. You guys have a book on tax strategies regarding real estate. It's pretty much where I started my journey when it comes to real estate tax benefits, and it just blew my mind and completely changed the way that I invest in real estate. Maybe we can just start off. You guys can tell us a little bit about yourself and how you got into this space and what you kind of do now.
Yeah, well, thank you so much for having us. My name is Amanda.
And I'm Matt MacFarland.
And we are CPAs and we're real estate investors ourselves. So like Michael said, we specialize in working with real estate investors. And so it's kind of the whole spectrum of people, like a lot of you who have full-time jobs, but also wanting to build passive income in real estate, all the way up to people who like do real estate full-time, large syndicators and things like that. So we started out our careers in one of the big four public accounting firms. I was working for the real estate specialty groups. I worked on a lot of like the real estate developers, public REITs and things like that.
Yeah, and then I also worked at a big four firm, and I was working on more like high net worth individuals, private client advisors, kind of business owners, real estate investors. And that's kind of where I had almost had like my aha moment. I think I was like 23, 24 years old, reviewing somebody's tax return. He was probably in his 60s. He was retired, and all he did was real estate. And you could quickly figure out on his return that even though he wasn't paying any taxes, he was making over six figures in cash flow. And I was like, okay, there's something here that I need to figure out what this is, right? So that's kind of when that light bulb went off, and we've been kind of focusing our niche on real estate investors ever since.
Yeah, I think we wrote our book on tax strategies for the savvy investor. It actually should be renamed to like tax strategies for the everyday investor, because it's really a compilation of different stories of how we work with clients and how people of all income levels, people of all experience levels, from newbie to all the super experienced, are able to use real estate to save on taxes. So yeah, excited to be here to talk with everyone.
Thank you for the introduction. If you guys go on Bigger Pockets is one of the biggest real estate communities I guess you could find on the internet. They're like the like CPAs that have like written the tax book for Bigger Pockets. I'm pretty, starstruck just being in the call here with them. Here's the thing. There are a ton of real estate investing strategies, but kind of the one that I focus on my YouTube channel is strategies specifically for high W-2 income earners. That's my avatar. That's the person I speak to on my YouTube channel, because that's me.
Yeah.
And I used to invest into real estate, buying smaller, cheaper homes. But then, considering the tax benefits, it kind of just changed my strategy in general. And so the two strategies I talk about the most, and what you guys talk about the most, is the real estate professional status and the short-term rental loophole. Just to summarize real quick for anyone who's watching who isn't familiar with these strategies, the main objective of either of these two strategies is to basically pay less taxes, I should say federal income taxes, on your W-2 income. So for all of you who are, making $500,000, paying $100,000 in taxes, and in federal income taxes, I should say, this strategy is a goal to reduce that. Is that correct?
Yeah, for sure. I think for everyone, right? All investors, I think the first goal is to just make more money without paying a lot more in taxes, especially for our high income earners. If you're working at Amazon or Google or wherever, if you're paying between federal and state, 30, 40, 50% in taxes, just our ability to have rental income and depreciation and not pay taxes on that money is already a win in itself. But I think then, once we achieve that, then the next step is sort of where you're talking about, like, well, then how do we effectively use real estate to offset taxes also from our earned income too?
Earned income is much harder to not pay taxes on. And so from what I've researched, these are the only two strategies that can really reduce your tax bill, by 100,000, maybe ish more. I mean, I know somebody who's saved over $100,000 in federal income taxes through the short-term rental loophole. And, the next best thing is really like a 401k. But even if you max it out, it's kind of like you don't save that much in taxes when you have a large tax bill. So the bulk of this video, I kind of wanted to talk about the short-term rental loophole. It's one of the two strategies I've mentioned. The reason why I'm not talking about the real estate professional status is it's quite more complicated. and about 95% of the people that I talk to don't really qualify for it anyways. So we're going to talk about the short-term rental loophole today. But if you want to learn more about the real estate professional status, you guys can go ahead and follow Amanda on social media, and she talks about it all the time. So with that said, what is the short-term rental loophole? Maybe you guys can give us a better definition for it.
Yeah, I think the first step is for anyone who's listening probably is just define what let's define what a short-term rental is for tax purposes. Because a lot of people hear the term short-term rental, they're thinking Airbnb, Vrbo. But just because you're listing a property on one of those platforms doesn't automatically make it a short-term rental for taxes. So for tax purposes, a short-term rental is really just where the average customer stay during the year is 7 days or less. So you add up the number of days that the property was used by customers, divide by the number of bookings. If it's 7 or less, you've got a short-term rental. If it's 8 or more, then realistically, you probably have a long-term rental. There's some exceptions to that, but that's kind of the general rule. So, so once you have a short-term rental, then the short-term rental just talks about where if you meet one of the requirements, which involves kind of how much work are you putting into managing your own properties and taking care of your properties. If you can meet one of those rules, and we can talk about those obviously, then if you can strategically create losses from your short-term rentals through like maximizing deductions, income shifting, doing maximizing depreciation with cost X studies, stuff like that. If you can create that loss on paper from your short-term rentals, then we can use that loss, basically convert it from a passive loss to a non-passive loss, like an active loss, and use that to offset all types of income, including W-2 income.
Mm-hmm. Yeah.
Right. And what you just said is kind of like the base of this whole entire strategy is, you talked about losses from our business, our short-term rental business. A loss is effectively when your business has more deductions in that business than it has income for that year. If a short-term rental property that I bought, let's say in June, makes like $20,000 of income, and then I have $40,000 worth of deductions because maybe I spent like 30 grand worth of furniture or whatever, and there's some other deductions, that calendar year I would actually have a loss of 20,000. And if that property was a short-term rental, you're saying that we can actually kind of carry over those losses of 20,000 and use it directly against our W-2 income. And so if I was making $100,000 from my W-2, I would now report to the IRS, I actually made 80,000. Is that correct?
Yeah, for sure. And this is, it's really important too that we define what a loss is, because I think a lot of people are like, why am I going to invest in something that loses money? And so when we talk about losses, it's not generally in the real estate realm, we're not talking about losing money. So ideally the property is still cash flowing, right? When we say rental income minus interest, taxes, insurance, and all that. But we are creating losses with a couple main things, right? One, Matt said maximizing our write-off. So we're taking a look at what are a lot of my personal expenses that I already have, and how can I legitimately shift those into business deduction? So common things would be like a car. I drive a car already, and it's a personal expense, generally speaking, but I'm also driving it because I'm going to my short-term rentals, I'm going to real estate meetup, I'm meeting with my CPA. So now I can start to shift some of that personal expense into deductible business expenses. Same for like a home office. Most of our clients that are short-term rental operators have a home office. So now I'm turning some of these like internet, utilities, security into business deductions. And of course, the most powerful one that we are alluding to is just the whole paper loss of depreciation. So when you hear people say, like, I bought a short-term rental and I saved $100,000 in taxes, it's not because they lost $300,000 of income. It's because they took this paper loss of depreciation to get to that loss.
Yeah. And I actually do know somebody who did save $100,000 in federal income taxes from buying one property, operating it as a short-term rental. And I don't know any other tax concept that can do that. Like a 401k gets nowhere close to saving you $100,000 in taxes, right? Even if you max it out.
I mean, for employee, you really can't, but for some of you, like people who are business owners, or you have like a side hustle, you develop an app or something, possible to do that. But with respect to real estate, high income earners, or not even high income, but just any income earner, you could be making $100,000 or $200,000 or $50,000. The short-term rental is really great for people who are doing real estate on the side. So I have my main job. Real estate was never going to be my full-time job. That's where this comes in really handy.
Right. And I think that's why it's such a powerful message for all these software engineers at Amazon making $500,000 and they're paying $100,000. And I'm just telling him, hey, look, if you buy one property, turn it into a short-term rental, not only will that short-term rental, if you choose a good one, like cash flow every month, but you'll also get significant tax benefits on top of that. So I think it's a great way to build wealth. But I would say maybe we can dive a little bit into the pros and cons, because there's definitely some cons to this approach, I would say. One of them being more involvement. Parents with 2 kids, 3 kids, like a lot of them, they just hear short-term rental and they're like immediately, I don't care about the tax benefits. I don't want to spend my time. So what would you say are kind of the main pros and cons of this approach?
Gosh, I mean, I think the benefits are pretty clear. You said
I think we went over the benefits.
Who
right?
saved $100,000. I mean, we have clients who saved $200,000, $400,000 in taxes using the.
And by the way, is there a limit to how much someone could save in taxes in 1 year using this strategy?
There is a limit. There didn't used to be a limit, but a new limit came out about, was it 2018?
Yeah.
Where it's not really a limit on the short-term rentals, but it's a limit against how much business expenses can offset W-2 income. And so outside of that limitation, it's called the excess business loss limitation. So this applies to people with high W-2 income, but not business income. So if you have a lot of business income, there's actually no limit to that. But I think, for most people, the short-term rental loophole works really well when you're just doing it as a side hustle. But a lot of that, we hear a lot of the same thing. It's like, I would love the tax savings. I don't actually want to do anything with respect to the property. So one thing to understand is to get clarity on what do you actually have to do? It doesn't mean you have to go fix toilets. It doesn't mean that the guests have to call you at 3 a.m. There are a lot of other things you can do in your short-term rentals that can help you earn the hours that you need for material participation. But I think one of the key things is to try to self-manage the properties because that gives you a lot of hours in itself.
Right. So I would say that's a big con too, right? Because one of the requirements of claiming short-term rental loophole is, like you said, you have to materially participate. And just for those of you guys who aren't familiar with that term, it basically means that you're involved in the business. You just have to qualify for one of those 7. So meaning you have to meet one of those 7 requirements. The one I see most commonly used is the 100-hour test. Is that true? Where you basically have to spend, as the business owner, 100 hours in your business and more than anybody else. Is that kind of the common one that you guys see being used the most, or is there another one?
So yeah, you're right. They meant there's 7 tests, and what we tell our clients is realistically 4 of them don't apply to 99% of the people out there.
Right.
So really, you're looking at one of these 3 remaining ones. That 100-hour test is one of those 3 tests. It's did you spend at least 100 hours, and it's more time than any other single person or any other single business spent on your short-term rentals. So for clients that or taxpayers that buy a short-term rental and maybe put it in service later in the year, that's probably the one they're using the most, because one of the other tests is you would spend 500 hours in your short-term rentals. And it doesn't matter how much time other people spend on it. But if you're buying it and putting it in service late in the year, it might be hard to get to 500 hours. So that's probably one where we see used. The 500 or that one is probably the one that we see used the most.
Yeah, and I think just to define it, if you earn 500 hours on your short-term rentals, then that's it. We don't care how many hours other people are spending at all. And if you go for the 100 hours, it's 100 hours and more than anyone else. And so commonly we're looking at the cleaning crew, the gardeners, how much are each of those people spending? And I have to have more hours than those people.
Right. And so I would say an additional con to this is that you have to keep track of these hours as the business owner. So you have to have a spreadsheet. You have to have certain proof, like pictures, text messages, calendar invites. I'm assuming those are all okay. And you have to keep track of this, not only the hours that you spent, but how many hours any contractors spent at your property doing any work. So there is additional work on top of running the short-term rental, which is managing your time or keeping track of your time. So I wouldn't say that this is a passive strategy by most definitions. It really is weighing the pros and cons and seeing if the pros outweigh the cons, in my opinion. With that said, maybe we can run through some example case studies. Currently, bonus depreciation, which is probably going to be the biggest. Oh, I see you're smiling as soon as I say that. So bonus depreciation is pretty much what this strategy is based on, right? Maybe you can kind of talk about bonus depreciation and how it really is at the centerpiece of this strategy.
Yeah, I mean, bonus depreciation, utilizing a cost segregation study, probably inherent as part of the strategy. For people who don't know, one of the, we talked about depreciation. What that is the IRS is letting you write off a part of the purchase price of your building every year against your income from that property. And there's certain ways you do it. Short-term rental, generally the building is written off over 39 years. Depending on the cost of that building, that could give you a good amount of depreciation every year. But to kind of supercharge that, then we look at, well, let's look at doing a cost seg study where they come in and say, hey, that building, there's some components of it should be depreciated over 5 years or 15 years. Again, that's better than 39 years. That gives you a better write-off sooner. And then when you throw bonus depreciation on top of that, they say those 5 and 15-year assets, right now you can write off 60% of it in the first year. And so that just, again, adds another layer of kind of supercharging your appreciation. So, over the life of the asset, you're going to get the same amount of write-off, but we're trying to take a lot more of it sooner, especially in years when we're actively involved in it. Because then we're just increasing that paper loss that we're trying to utilize to offset our W-2 and other income.
And what I really love about depreciation is that it's purely a paper loss independent of like the cash outlay you have. And so you could be someone who, if you put $20,000 down on $100,000 property, the depreciation is going to start with that $100,000 purchase price. Or even if you're able to get something with, no money down or 5% down, it doesn't matter. The depreciation calculation is exactly the same. And so the more comfortable you are, the more comfortable you are with leverage, the more tax benefit. Robert Kiyosaki talks a lot about the fact that his wealth was built on debt and taxes. Right. And this is a great example using real estate in the short-term rental loophole specifically, how, we just use the bank's money to buy the property and then use the IRS code to get our tax benefit.
Yeah. And I think I can throw out a small case study here of a property that I didn't use the short-term rental loophole, but I used real estate professional status, the other option that we're not talking about. But effectively, the strategy is the same. It's just how you claim it, I guess, or how you qualify for this benefit is different, I guess you could say. Mm-hmm. But effectively, if I were to do a small case study, I bought a property in Texas for 10% down. So it was a $500,000 property. But I put roughly about $50,000 down just to round out the numbers. We did a cost seg study on that property, and it was calculated that we would be able to claim a deduction for bonus depreciation equivalent to about $100,000 for the first year. All things considered, the income from the property and other deductions as well, we ended up having a loss of about $100,000, close to that number. And so that's the number that I was able to use to offset my W-2 income. And so at my tax bracket, that was about a $30,000 tax savings, which is crazy to think about because I spent $50,000 to buy the home, but because of this home, I'm getting back 30 grand on my tax return. And so that's really where the benefit of this strategy comes into play, because I'm effectively getting back an instant, I wouldn't say rebate, but it feels like a rebate, right, for buying this property. I want to talk about there's another con, right, with selling the property. I was wondering if you can kind of explain, what happens year 2 and beyond. Because in year 1, we claimed a $100,000 deduction in the name of bonus depreciation. What could I do with a short-term rental? Could I perhaps convert it into a long-term rental at some point? What are kind of the strategies that you kind of advise after year 2 of owning this property?
Yeah, I think it's, that's the beauty of tax planning, is that the IRS doesn't restrict how a property is used. And so there's no rule that says because it was a short-term rental last year, it must remain a short-term rental forever. So for a lot of our clients who are like, hey, I love the tax benefits, but I don't really foresee myself being very active in short-term rentals, it's absolutely fine to turn it into a midterm rental the subsequent year. We see a lot of that with our clients because in the short-term rental space, you already furnished the property. And so it's easier to rent it out as a midterm rental, kind of that middle ground of higher prices, but not as much work. Right. Or you could turn it into a long-term rental too.
Right.
And also, because the short-term rental loophole is specific to a year, you only really need to meet those hours requirements for material participation in the year that you're going to use the benefit. And so if for me, I'm buying a property, I want to use the strategy in 2024, I don't have to continue to self-manage or earn the 100 or 500 hours next year, right? I don't have to do that. I could if I chose to, but I don't have to do it anymore.
Yeah, one thing, so having said that, something we see with our clients a lot is that similar to you, they like the benefits they're seeing on their tax return, right? So maybe year 2, property number 1, they kind of convert it to, give it to a property manager, let somebody else manage that one. But in the meantime, they've gone out and bought property number 2 or property number 2 and 3. They're going to be short-term rentals, and they're going to focus their time on those 2 properties in the second year, do a cost-seg study, create that paper loss again, kind of rinse and repeat, if you will. But they don't have to do that with every property, right? Because they've already got the big benefit from property number 1. So that's another way that people kind of, they get, they really like the benefits. So they want to kind of keep that ball rolling.
Like an addiction,
Right.
a tax addiction.
I didn't want to use that word, but
I am
yes.
addicted. I'm completely addicted because I've been doing this for the past 2 years. 2022 was the first year. My wife became a real estate agent at the beginning of 2022. We did not know what real estate professional was. And then halfway into the year, we're like, oh my God, what this thing is like, this is perfect. Like, this is going to help us pay no taxes or less taxes on my income. And so that year I paid a significant, I didn't pay that much taxes in federal income, I should say, as opposed to what we were supposed to pay. So with that said, I want to kind of shift a little bit into, now that we understand kind of what the main benefit of the short-term rental loophole, which is effectively, buying real estate and leveraging that real estate to lower our taxable income or our AGI, which we report to the IRS. So, effectively, instead of reporting, hey, I made $500,000 to the IRS and then getting taxed at $500,000, maybe you go buy a $1 million property, do cost seg, claim the losses, drag over $200,000. And now instead of reporting 500, you say, hey, I'm only making 300K. And that's a pretty significant tax savings between 500 and 300. So with that said, what other benefits kind of can we combine with the short-term rental, knowing that our AGI is going to be lowered once we kind of execute this plan? So let's say, from 500 down to 300, I can think of a few off the top of my head, but the main ones I wanted to cover was Roth conversions, maybe qualifying for some credits. So like for example, the EV credit. So maybe we can start off with the EV credit, the EV tax credit.
Yeah, and what's really interesting in the tax world is that a lot of times you are doubling up on these benefits, right? We talked about when you're using short-term rental loophole, you get to take depreciation. We double up on that with accelerated depreciation. Now your income is so low for a lot of our clients, once we start working with them, they start to get these credits, child tax credit or EV credit. Back during 2020, when there was a stimulus bill with the rebates, we had a lot of clients who were physicians, and they're like, wow, I had no idea I would qualify for the stimulus checks because I make so much income. And that's a really powerful example of how when you're using these strategies and it's bringing down your total income, now you are considered potentially low income for tax purposes. And these types of credits start to become available to you for the first time. And sometimes it's kind of like a surprise, right? So the EV credit, for example, I think based on, last or this year's income is about $300,000 for married, $150,000 for single. And so if you're someone who made, single person who made $200,000 of income, that's your normal AGI, but with the short-term rental loophole, you got below 150. Well, now all of a sudden you can also reduce it further through things like, these types of tax credits too.
Nice. Yeah. Well, I've actually never heard of this happening. I just kind of, the puzzle pieces kind of fit together. I was like, EV tax credit is based on AGI. So if I use the short-term rental loophole, lower my AGI, would I be able to? So it's really nice that you were able to confirm that is the case, because I think me and my wife may be doing that this or next year. So that's
the part of the beauty and power of working with a tax strategist advisor is that on the face of it, you're like, okay, I cut my income by 200,000, my tax rate is 30%, I multiply that, I get, I can't do math in my head, 60 grand, something like that, right? As a savings. But you forget, sometimes people forget about these other ancillary benefits. I mean, credits might apply. Maybe you're somebody that got, all of a sudden you weren't able to do, you mentioned Roth convert, but even a Roth contribution, like if, married couple, your income's got to be below $220,000. Now all of a sudden it is. Now I can contribute to a Roth that I couldn't do before. Maybe maybe it's bringing my income down so that my my pre-tax retirement contributions are now deductible. So there can be all added benefits, not just the, deduction times 30%, right? So we see that all the time.
Right. So what you're saying is there actually is some benefit to making less money or reporting less money, right?
Having less taxable income.
Yes.
Lowering your taxable income, making less money. Right? Or I guess you could say. So, okay. Well, another like strategy that I've come across recently is the Roth conversion. And so maybe you can touch on what is the Roth conversion and how would it be kind of combined with the short-term rental loophole, similar to how the EV tax credit worked.
Yeah, no, we love talking about Roth conversions. I think in the right situations, it can make a whole lot of sense. I mean, for people's benefit, we've got pre-tax retirement accounts, so like traditional 401k, you put money in, you usually get a deduction, gross tax deferred, you pull it out, you pay tax, right? The Roth a little bit different. We don't get a deduction when we put the money in, but it can grow tax-free, so when you pull it out at retirement age, don't have to pay any taxes. That can make sense. So looking at Roth conversion is basically just moving money from that pre-tax bucket to the tax-free Roth bucket. And that can make sense if you think your tax bracket is going to be the same or higher in the future. So if you're somebody that thinks, hey, I'm at 40% right now, and I'm certain I'm going to be at 40% in the future for various reasons. We don't have a crystal ball, but if you think you're going to kill in the next 20 years and make a crap ton of money, or you think tax rates are going to go up because the government's printing money, various reasons, right? Then it can make sense. But the idea being that we want to do a conversion in years when your tax rate is lower than what you think it's going to be in the future. So if with the short-term rental loophole, real estate professional, other things, if you can bring your income down from 37% to the 24% bracket, and you think it's going to be 37 in the future, mathematically, it's going to pencil out. You could look at doing a Roth conversion this year because now that income, you're going to, you may not save as much taxes as you had without doing the conversion, but overall to the lifetime, you're going to save taxes for sure.
Right. And basically what you're doing is you're pulling money out of a pre-tax account, so like a 401k. And the aftermath of that is that your AGI is going to go up, right? But so I guess a good example would kind of be like, let's say you're making 300k, you go buy a lot of real estate and you drive your income down to, maybe like zero. At that point, any dollar that you pull out of a 401k, you're going to be paying as if you're in the lowest tax bracket. So it's a really good time for you to pull money out of that pre-tax account and maybe now move it into
use up those lower brackets.
Exactly. So I think people don't really understand tax brackets to this level, and that's really why I wanted you guys on today to kind of talk about these things. Another thing is, what about capital gains? If you utilize the short-term rental loophole, lower your income down to, let's say, a zero AGI, which is very aggressive, but let's just say that was the case. And then let's say you had, $100,000 of capital gain stock. Would it be a good idea to sell it then and report a $100,000 capital gain while your AGI is zero? What would that look like?
Yeah, for sure, because there's various. I mean, a lot of people think when we sell capital assets, we get a federal tax rate of 15%. A lot of people are familiar with that. Sometimes, but your long-term capital gains can be taxed at 20%. And to your point, sometimes it can be taxed at zero, depending on what your AGI is. So it might be a situation where someone's already got capital gains they were going to pay 20% on. Now with a short-term rental loophole, their income's low enough that they're only paying 15% on it. Or their income is at 0% right now because they've done all that. And so if they convert or they sell some stocks, they may not have to pay any capital gains tax on that stock, depending on what their AGI is. So a lot of moving pieces, but that's where it's kind of, again, the beauty of kind of doing tax planning. And we kind of like to say tax planning is like a year-round sport. It's not something you talk to your person about on April 10th.
What I like to say is that tax strategy is like, it's like chess, right? Mm-hmm. And hiring you guys as a tax professional is like having a grandmaster next to you, teaching you how to play that game, right? Whereas like if you play by yourself, you're gonna lose.
Grandmaster Yoda, that's what I call myself.
Yeah, exactly. And so like you're definitely going to be in a much better spot with some grandmaster sitting next to you, teaching you the game and teaching you how to use these strategies because timing is so important, right? In these strategies, right? When are you going to withdraw from your 401k? When are you going to do the Roth conversion, right? When are you going to buy the short-term rental? When are you going to buy the EV? Timing is a really important piece in the tax strategy game, because if you want the tax strategy that year, you need to perform that year. And so a year seems like a long time, but it's already May, and I have, I need to go buy some real estate now if I want to pay less taxes this year. And, it's already May and I feel like time's flying. So it is quite hard to execute on these plans. But I think generally speaking, at least with my tax strategist, we kind of plan at the beginning of the year, like January, February, and then I execute throughout the rest of the year. Whereas most people, they don't even know that tax strategy is a service. They only know about tax prep, which is, I would say, maybe the lesser important service that you can purchase from a CPA, because by that time, the year is already over. Even if they give you some advice, you're probably not going to have enough time to execute on it. And so that's why, I love talking to tax strategists, because especially for people who are high W-2 income earners, they don't even know that this service exists.
And I think one of the things too, for a lot of our high income earner clients, one thing they're always looking at is like, okay, should I put my cash into work 401k or should I use it for real estate? And so, I mean, I know, although the answer would be different for person to person because there's a lot of considerations. But one example that's really powerful is we had a client who was very high W-2 income for many years. He was single, never married, so couldn't really use the real estate professional status, didn't really want to do the short-term rental loophole. But we knew he was going to retire, or, it was kind of early retirement, if you will. And so what we had suggested he do is actually to maximize his work 401k contributions every year. For him, it was like, I'm not going to use the tax benefits today, but I am going to get the benefit of putting into retirement. And so in the years he was funding retirement accounts, he was saving taxes close to 50% between federal and state. When he retired, though, it was easy for him to be a real estate professional, right? Because that's all he had to, that's all he was doing. And so it quickly shifted where now he was in the scenario where he had negative income. And because he had negative income, we were able to then take all that 401k money that he built up over the years, convert tax-free to the Roth. And so if you look at it holistically, it was pretty amazing because he saved on that same amount of money, he saved 50% taxes. And then he turned around at zero tax rate to turn it into tax-free money. That's forever tax-free. And he was able to use that Roth money in the self-directed account to reinvest it in more real estate. So it's really, really powerful when you can do this kind of multi-year planning, not just in 1 year, but here's where I see myself in 2 years or 3 years. What should I be doing now to prepare for that?
And now that client refers to me as Grandmaster Matt.
I don't think so. I think that's a lie. No one has referred to that except you. Michael's the first person who's.
But I'm going with this. I'm going with this from now on.
Yeah, you can take that name from now on. Just change your name signature to Grandmaster Matt.
Yep. When I go to T-ball practice later today, I'm Grandmaster Matt.
Yeah, I mean, I can't think of a better analogy. It really is that it's a strategy, right? It's there's so many angles, and there's quite a bit of tools, right? Like I love how there's this interplay between 401k and real estate and how to kind of leverage each other to like, I don't know. There's a lot you can do with 401ks. I actually withdrew from my 401k last year to buy some real estate, and yeah, I just paid the 10% penalty, but I think. I basically used that that withdrawal to buy some real estate, and that real estate lowered my AGI by, it was actually the Texas property, so it lowered my AGI by $100,000. So the AGI or the 401k withdrawal increased my AGI by 50,000, but by buying the real estate, it lowered my AGI by 100,000. So net, it was about I lost dropped my income by about $50,000. So. I'm not sure, to be honest. I didn't pencil out the numbers to make sure if it was better on 401k versus real estate. But at least right now I have some cash flow that I can use today rather than in the 401k. I can't really benefit from any, cash flow today. So I like the real estate play a little bit better in my mind.
Well, and I think something that we work with a lot of our clients on too is how do we tap into other sources of money tax-free, right? So in your scenario, you said, well, I tapped out, I paid federal and state taxes and then maybe penalties on top. Another option might have been, what if you just borrowed from your 401k, right? So instead of taking a distribution, if you had borrowed from it, it would be tax-free, penalty-free. So you could have had the whole amount to use for real estate investment rather than the after tax, after penalty portion. Exactly. And also the benefit is that then the money can at some point return to the 401k to continue to grow tax deferred too. But all of this, like we're saying, is with tax planning. And I think you're exactly right. Most people don't do tax planning. We're always so worried about tax return filing. I think 90% of the time when people come to us, they're like, can you file my taxes? I always tell them well, that's less important. What's more important is to do tax planning. And just because most CPAs don't do it, and that's kind of a huge missed opportunity.
Right. So I want to talk about, I think that's a really good point. I think right now, though, we're kind of in a situation now where the centerpiece of this strategy, the short-term rental loophole, which is bonus depreciation, isn't actually at full efficient, or what do you call it? Full capacity, I guess you could say. So in 2024, if you guys aren't aware, bonus depreciation is at 60%. And it's kind of hard to explain like what that percentage really means. Do you want to try taking a stab at it?
Well, yeah, I mean, historically, so historically, we don't really have bonus depreciation, right? In all the years, we know that wealthy people invest in real estate, politicians invest in real estate because of depreciation benefit in general. I think a lot of us have been spoiled in the last several years, but we had, on top of regular depreciation and accelerated depreciation, we had this third layer called bonus depreciation, where it was up to 100%. And so now I think, yeah, we've had people who are like, oh my gosh, is it going to be terrible? Am I not going to save any taxes? No, you're still going to get very good amount of tax savings. It's just maybe not as great of tax savings as when it was 100%. But something very important to understand is, when we say it's 60% bonus, we don't mean you're losing out on 40% of depreciation. Not at all. All we're saying is you get to write off 60% immediately. The remaining 40% of depreciation, you're taking it over the life of the property. So if it's a 5-year property, you still get the rest over 5 years.
So I think putting some numbers to it, right? A great example. You spend $100,000 on furniture or equipment for your short-term rental. With bonus depreciation, you can write off right away. You can deduct $60,000 plus a small portion of the remaining 40 grand. So maybe it's, maybe the first year you get $65,000 of a write-off. Year 2, you get another, $5,000 to $10,000 depending on the calculation. So basically over 5 years, you're writing off 100 grand, but in year 1, you're getting 60 to 65%. If it was 100%, then obviously we would have deducted $100,000. So 100% is better than 60, but 60 is better than 0, right? So.
And I will say there is still a proposal that's going through legislation. It's passed the House to potentially bring back 100% bonus depreciation to 2024, 2025, and also retroactive to 2023. The fate of that piece of legislation is unknown. It's not looking super good at the moment just because of politics, right? But it's definitely a really good bill that's in reality supported by both parties, but politics sometimes gets in the way of getting things moving.
Yeah, currently it's just sitting on the Senate floor waiting to be voted on, but they've just kind of been stalling it out. But I
think it's a piece of paper on the actual floor. They're just there's a lot of them. They just push it around.
It was the first time I ever looked at tracking a bill because it's so important to me. Like I've been watching it like a hawk. I've been even gone on the Congress.gov website and tracked like the actions taken to this bill, and it pretty much says that it's waiting to be voted on, and there's nothing else can really. There's no other status update.
Yeah. We have clients who text us thinking that we're actually on the Senate floor watching it and talking about it. So they want to know what our update is on it. You're gonna call your congressman. I'm your tax advisor.
Yeah. So we will see what happens with that. But generally speaking, and I'm gonna use really rough numbers here. When I bought the $500,000 property, I was able to claim about $100,000 in the name of bonus depreciation that year, which ends up being about 20% of the purchase price. Now, this will vary quite a bit depending on what type of property and stuff, but just for conversation or just to make this kind of generic or easy to understand, when bonus depreciation was at 100%, I used to kind of use 20% as kind of a base number to kind of signify how much losses I would be able to generate from that property in the first year. So if it's a $500,000 property, I'd be looking at roughly about $100,000 in losses, which I can then use against my AGI that year. That's when bonus depreciation is at 100%. So if bonus depreciation is at 60%, maybe I use like 12%-ish, somewhere in the ballpark of that. So if I go buy like a $500,000 home this year when bonus depreciation is at 60%, could I expect somewhere in the ballpark of like maybe, I don't know, 60,000, give or take maybe like $15,000 or so?
I think it's really hard to say because it depends on a lot of factors. It depends on the property, where the property is, the profile of the property, single family, duplex, multifamily. It also depends on which cost segregation firm you work with too, right? In terms of how aggressive they are. Back when there was 100% bonus depreciation, I think our rule of thumb is between 15 and 30%. of building is usually what we see in that range. I mean, it's a pretty big range, 15 to 30%, right? So yeah, I would say some haircut version of that in 2024. But I think for everyone on here, we don't have to have this guessing game. Before you buy a property or right after you close on a property, you can always get a free cost segregation analysis. All the cost segregation firms provide this to you free of charge. You just need to give them your purchase price and the property address, and they'll give you a pretty detailed estimate of what they think it's going to be. And so we have clients who we do this for before they do the buy, as part of the buying decision. I'm looking at the property in Texas on this street versus that street. It might be one street away, but the land valuation might be very different. And so maybe that's part of that buying decision.
Or a property is a lot old. Maybe one property is a lot older than the other one. So theoretically, this one's got some higher value stuff in it,
Right. Yeah. And I've, this year, I'm actually looking to buy some multifamily just because I hear that I can kind of consolidate my portfolio a little bit rather than keep buying these single family homes. But, I started looking into other asset classes besides single family. For example, mobile home parks. And mobile home parks, I recently learned, have one of the best tax benefits. I would say, I don't know. I just heard this on a podcast somewhere, but they said somewhere in the ballpark of if bonus depreciation is at 100% for a single family home, if you buy like a $500,000 property, you can expect around 20%. For mobile home parks, they said that percentage is typically closer to 70%, meaning if you buy a $1 million mobile home park, you could walk away with, in that first year, around $700,000 of losses that you can then use against your W-2. Or I should say, I don't know if in that case, you wouldn't be able to use that against your W-2, would you? Because that mobile home park you're not using the short-term rental loophole.
It just depends, right? So mobile home parks are long-term rental. So if you were going to do that, if you or your spouse meets real estate professional status, then yeah, possible to offset.
So that's more of a real estate professional status strategy.
I guess theoretically you can buy a mobile home park and operate it as a short-term rental. We have clients doing something similar. It's not called mobile home parks. They call it glamping, more like glamping sites where they put RVs on it and, things like that. So yeah, some variation of it could still be short-term rental or more like a boutique hotel type of business, which is kind of the newer version of the short-term rental loophole that we see with some of our clients getting into that boutique hotel space. But yeah, mobile home parks are really great for cost segregation. The reason is because a substantial part of what you might be investing in is land improvement, and land improvement is eligible for bonus depreciation. We see similar things for like car washes, gas stations, a lot of those, the types of real estate that where you can allocate a lot to these assets that are eligible for cost segregation.
I wanted to shift the discussion a little bit to kind of further down the road again, because most of what we're talking about is kind of a year one benefit. We're like focusing on the first year's benefit. We're like, oh, look, you get to save like, 50 grand in taxes, whatever. Troy asked a question here. Troy Smith, if you're on the webinar here, he asks, what are the implications for selling the property if you take bonus depreciation in the first year?
It's a great question. So definitely something to consider, but not something to necessarily be scared of. So, because we do hear this a lot, but for people's benefit, when you buy a property, you're taking depreciation, regular bonus, whatever you want to call it, your tax basis of the property is now being reduced because you got the benefit from that expense. So if you bought it for 500, you took 100,000 of depreciation, your tax basis is now 400 grand. So if and when you sell it for anything more than $400,000, you're going to have gain on sale. If you sell it for more than 500, that first $100,000 is what they call depreciation recapture. Sometimes that's taxed at 25% rate instead of a capital gains rate. Sometimes it can be taxed at ordinary income rates, depending on what your ordinary income rate is. Big picture, if you're someone who's going to look at utilizing a cost segregation study, generally it's going to pencil out if you're going to hold the asset for more than 3 years. Now it can work if you hold it for 2 years, but generally speaking, it's probably hold it for three or more. And that's because of the depreciation recapture. So to his question, I think I would just something to talk to your tax advisor about and kind of figure out, hey, what are some options here? I'm looking at maybe selling this. Should I do that? Should I 1031 exchange it? Something else,
Yeah. Yeah, 1031 exchange is a great strategy. You can actually defer some of that depreciation recapture. I don't think you can defer personal property, which is kind of a piece of depreciation recapture, I believe, right? You can defer a big majority, depending on how long you hold that property for. You can actually defer some of that depreciation recapture, and you can use those gains in the meantime to go buy some more real estate. That's basically depreciation recapture in a nutshell. There's basically, if you buy a property, claim bonus depreciation, and then decide I don't want anything to do with this, but you already received the tax benefit. In year 2, if you sell it, you're effectively just gonna have to pay those taxes back, right? That's depreciation recapture.
Yeah, and that's where planning comes in.
Right.
You can look at offset strategies. Maybe I'm reinvesting that money into more real estate outside of a 1031. Maybe I want to invest in an opportunity zone. Maybe I'm just going to get into a syndication deal. Right. Someone else's deal that gets me the losses. So yeah, I think like Matt said, don't be afraid of depreciation recapture. Just like don't be afraid of an audit. You just want to be prepared. And if you have a plan, well, first is build your plan. What is my plan going forward? And then how do I work that plan and make sure it's implemented? Right? I think that is the most common mistake we see is people thinking that, hey, you're doing my tax returns. I'm assuming you're planning for me for next year. But we all know that almost never happens,
Right. Yeah. And again, you can maybe going back to the short-term rental loophole, right? If you have a year where you do want to sell some stuff, but you have depreciation recapture, maybe you go out and buy a lot more real estate first, drop your AGI to 0, and then sell some of those properties that have depreciation recapture. That way, you're still in the lowest tax bracket when you sell those things, right? It all goes back to the playing with your AGI and kind of knowing how much you need to buy to kind of play with that AGI.
Yeah, and I think it's funny because I was, talking to somebody recently. We were teaching at a conference, and they say, I only have one rental property. Does it make sense for me to do tax planning with you? Mm-hmm. And this is a great example. Like our conversation today is, sure, we're talking about real estate, we're talking about the short-term rental loophole, but we also covered ground on a lot of different things. Like you're selling stock for gains, you have your W-2 income, you have money in a 401k, and so planning is never about tunnel vision of just one rental or just my W-2. It's how everything works cohesively together to mm-hmm. reduce your overall taxes.
Right. There's countless number of tools that they all kind of interplay together. And like I said, that's the grandmaster strategy is how you kind of fit everything together. So yeah, that's great. Well, we're kind of nearing the end here. We have 8 minutes left. There's one question that I think is really relevant. I haven't heard anybody talk about this, but I've actually been doing this. And Peter Talbot says, if you're planning on buying a short-term rental this year to offset your W-2 income, would you modify your tax withholding with your employer going forward, or do you want to wait until you file your taxes next year?
Yeah, this is a great question. It's I definitely encourage you to kind of look at that after you've bought the property, right? Like after you've kind of, got an idea of like, okay, we got the free cost seg analysis done. I get an idea of I'm going to be able to create an extra $80,000 depreciation. This is where I think my loss is going to be, my income, how much tax is going to save me. Then you definitely want to look at that withholding analysis to kind of revise it, because otherwise you're letting the IRS basically hold on your money until April or October of the following year when you could be reducing your withholdings and get them, basically keep that money now. So that you can then turn around and use that money as another down payment on another property, right? So it's either It's just kind of accelerating your wealth building versus waiting until April, October of next year.
Yeah, and I also too, if you don't change your withholdings, what might end up happening is you get a big refund next April, and big refunds sometimes result in audit exposure. Why? Because when the IRS has to write you a big check, they don't like that, just like you don't like writing a big check, right? So it's more, the possibilities are higher that somebody on their end is going to look at it and say, okay, what happened here? Why are we giving out such a big refund? So yeah, certainly makes sense. But I think, before you change your withholdings, obviously make sure you're pretty confident you're going to meet the material participation hours requirements, because it's not just, I bought a short-term rental. The IRS just they had $80 billion more for their budget. I think the Congress just took away 20. So now they still have $60 billion more funding. And audits are certainly on the rise. And so when we talk about a lot of these strategies, you have to make sure you're doing the right things, the right documentation, spending the actual hours on it, because we are not talking about saving $1,000 or $2,000. We're talking about saving $20,000 or $200,000. And so if you use some of these strategies and you are just kind of doing it Mickey Mouse, you can't really support this or that, then if you're audited, it's going to be a pretty painful experience to have to pay that back plus taxes plus penalties. So do it right.
Yeah, I will just say that I actually do this. So on my W-4 form, there is a section on the W-4 that says, are you expecting any other deductions? And so in that field, I will basically put the number there that I think I will receive in losses from my real estate business this year. So I'm expecting to have about, let's say, $300,000 of losses from my real estate business that I am planning on carrying over to my W-2. So on that W-4 form, I actually put $300,000 in that deduction field. So currently, I'm not paying any federal income taxes on my salary. Now, if I don't perform this year and buy that real estate, if I don't generate those $300,000 of losses, I'm going to owe a very big tax bill come April. But if I do perform and I do actually get those $300,000 of losses and I use it to reduce my W-2, then that's exactly how much taxes I should have been paying, right? And so people don't really understand tax withholding. But I think it's super significant because if your tax bill is $100,000, that means you're withholding an extra $100,000 over the course of this year, whereas I'm not paying that. So I have an extra $100,000 this year that I can spend this year, right? And that's super important to understand because I hadn't been doing that for the past few years. But I will, it is quite aggressive because again, it's forcing me to have to go buy that thing now because I'm really claiming it already, right? Is that something that you would suggest, or am I being too aggressive?
You can, depending on your employer, a lot of times they offer you to adjust your withholdings before year end. So for a lot of our clients, was part of the planning. If by the third quarter we don't think it's likely to happen, then one option is to say, well, withhold the rest of my paycheck as income taxes. It's the benefit of that is that protects you from penalties of underpayment penalties. The downside, of course, is you have to be someone who budgets really well because we're saying the last 3 paychecks will be zero. It's all going to taxes. But definitely, if the alternative is I'm going to overpay in taxes and wait for a refund, a year later, that's less ideal.
Yeah, especially if your tax bill is humongous, you could have used all that money to invest this year. That's kind of what I'm doing. Again, I would say it's definitely more aggressive. So with that said, you guys have been here for quite a while, and you guys have given us so much knowledge. So thank you for that. Maybe we can kind of conclude here by maybe ending with of any resources for. Again, my audience is high W-2 income earners. Any resources for them to learn more about this?
Yeah. So our website is called Keystone CPA. Our company is called Keystone CPA. Our website is keystonecpa.com. And we have a lot of great free resources on there. We talk really in depth about the short-term rental loophole itself and real estate professional status for those of you who are married to someone who can be a real estate professional. And like I said, we have a lot of clients that are high income earners that either already have a good portfolio or are aspiring. They don't want to live exclusively off of W-2 income forever. So they want to start building that side passive income. And so, it's a multi-year planning that you go through. So yeah, additional resources, definitely visit our website to check it out. And then if you're looking for daily tax tips, the best place to find me is on Instagram as Amanda Han CPA. And then Matt will be there too sometimes. Grandmaster Matt.
Sometimes I'm Grandmaster Matt as a videographer.
You change your Instagram handle if you
right.
To
the other thing I was going to mention for those people who might be interested too is we are speaking live at the Short-Term Rental Summit in Denver, Colorado, June 23rd through the 25th. So it's kind of one of the premier events for short-term rental operators in the country. Beautiful location. So I know there'll be a lot of great information, a lot of great speakers there as well. So that would be something people could check out.
Yeah. That's who's that hosted by?
So it's actually by a client of ours, Tony and Sarah Robinson.
Oh yeah.
They authored the Bigger Pockets book, and Tony has a very good story too. He was working at Tesla when we first met him, and and then he kind of went all in the short-term rental space.
Yeah,
and it's been pretty transformational.
I'm very familiar because I was actually their neighbor in Josh Tree. and I had bought a property on the same like block as them, I believe.
That's funny.
And the timing of everything was exactly the same. So he made a video about like how he bought this property, did this stuff, and he like sold it at the around the same time that I did. So it was like pretty much my exact same scenario. So that I followed him quite a bit. So I guess one last question before I let you guys go. So a lot of my Amazon coworkers are H-1B visa holders. Are you familiar with H-1B, or like if they can utilize this strategy? What are kind of the nuances with being an H-1B visa holder and utilizing?
I mean, I don't know that there's any limitations in terms of visa status. You know, if you're filing a U.S. resident 1040 tax return like anyone else, you know, generally there's no limitations. I think that the times we've seen limitations are people who are unable to work. You know, like you're here on a visiting visa, you cannot work. The question becomes, can I be a real estate professional if I'm not technically supposed to be working? But I don't think that applies to any of the coworkers at Amazon. They're clearly, you know, working in the U.S.
Right. Okay. Well, I think that's all we had. Thank you so much for joining today and giving us so much knowledge. And hopefully, maybe I'll consider going to the short-term rental summit in Denver. You said mid-June, end of June?
Yeah, it's June 23rd through the 25th.
Okay. Well, any last things before we let you go?
No. Anything else we need to mention? You know, I was going to say, I know Tony put a coupon code for anyone who like, you know, wants to go to the short-term rental summit, but I don't know what my coupon code is. I'm so sorry. You can try Amanda or Amanda10, but I really don't know.
I'm sure it'll be somewhere on social media. You guys can follow. I think it's Tony and Sarah Robinson on. They have a YouTube channel.
Yes, yeah. I mean, yeah, they're everywhere too on like
I think
social
it's the
media
Robinsons
and stuff.
is their YouTube channel.
Yeah, Meet the Robinsons or something like that.
Yeah. Yeah. Okay. Well,
Thanks for having us, Michael. It was fun.
Yeah. Thanks so much for joining.
Yeah. Thanks,
all
everybody.
right. Thanks,
Bye.
everybody.